What's going on, guys? In this video I wanted to discuss how to dollar cost average and build out a position effectively, and I wanted to do this by going over a position that I'm currently building out in Alibaba. So if you like this video, make sure you drop a like down below, and if you want to see more videos like this, make sure you hit the subscribe button. So the first thing you need to do when you're building out a position is determine the max risk that you can have, that you're comfortable with for that position. So in this example, right, we're looking at Alibaba stock. I am going to say that we have a $100,000 portfolio, and what the kind of consensus is around positions is 10 to 25 positions. So 10, you're going to be not super diversified, so you can kind of put more money into fewer positions. 25 positions, you're going to be basically more well diversified. So that's kind of a personal preference thing, and a lot of these numbers are basically subjective to how you're feeling. So what I've done here is said that for a $100,000 account, you are going to have either $5,000 for your position size, or anywhere between 5,000 and 15,000. So what that means is, right, you'd have 15% of your account in one position, or you'd have 5% of your account. So if you had 25 positions, you'd probably be closer to that $5,000 mark. If you have 10 positions, you're going to be kind of a little bit closer to the $15,000 mark. So what we're looking at next here is 3 different categories. So this is just a way of numerically showing kind of what my thought process is when I look at a stock. So you have risk, reward, and personal comfort. So to go through all these, risk and reward are kind of backwards numerically. So the higher this number is, it's a 0 to 5 scale. So the higher this number is, basically the less risk I personally believe there is in this stock, being Alibaba in this case. The higher the reward means basically, right, it correlates directly. So the higher, the more reward, the more dollar profit that you're going to take from a position, the higher this number is. And then personal comfort, that is super subjective. That's kind of wherever you're looking at. So the lower this number is, basically the more conservative you want to be. The higher this number is, the more aggressive you want to be. So what I've done here, right, so I'm looking at risk. I would look at Alibaba and I'd say there's risk associated with the cost or the stock price, and then there's also risk associated with obviously other factors. So in Alibaba's case, you have a lot of other factors where you have basically political environment in China, kind of what are they going to do, what is Xi Jinping, how is he going to basically go after these tech companies, is he going to make them or allow them to kind of do things kind of more freely. There's also the risk of basically being delisted in the US because of not being able to audit a lot of their earnings and other findings. So in my personal belief, I think it's a 3.5. I don't really think the stock is going to get delisted. I think there's a lot of money in it, and I don't really see that happening. So basically I said I believe that's a 3.5, which again is a little bit above kind of the middle ground. So the other risk that I'm looking at, and what personally takes a higher factor in here, is stock price risk. So it is down significantly, so I don't personally see it dropping another 50% or 25% or anything like that. So that's kind of where I'm getting personally to that number. Reward, the way I look at this is, right, if I'm down around like a 2.5, I'm probably not putting money into a stock to begin with. I'm generally looking for a 4 to a 5 on my scale of reward, which a 4 to 5 for me would be basically being able to double up my money, so make 100% return. So that's why I have this number at a 5. And then my personal comfort, I tend to be more conservative, so I put this down at a 2.5. I don't want to have a ton of money tied up just in one position. So what I've done here basically is represented that with a score of 11. So that's just the addition of all those numbers. And then you have a max and min, so the max possible score would be 5 across all of these, which would be a 15. So in that case, I would be contributing $15,000 for a minimum. Technically, I should never have a minimum because if I had 0 across all these, I wouldn't consider the reward to be worth it. But in that situation, you'd be at $5,000. So what I've done is kind of worked that out. Done a little math, seen what percent you have there. So this is 73% is basically this number divided by this number, which means I need to increase my position size by 7,333. So what we've done here is basically just added that number onto the $5,000 number to get my personal position size of $12,000. Basically $12,333. Again, you can run these numbers and kind of, this is really just a numerical way of being able to figure out kind of where you feel you should be on a stock. So the next step we have up here is determine where you are comfortable buying. So this will be a little bit different for everyone as well, but personally, like I mentioned earlier, is I am looking for 100% returns on a stock. So I want a stock that is down 50%. So if the stock price is like Alibaba, we have a price target. So my personal price target is $300 and the current price is at $140. So what this presents is 114% upside, which is a potential profit of $14,000. So on that $12,000 position, basically my new position, if it went up 114%, I would have a position size of $26,000. So again, the way I get to these numbers, so 300 for Alibaba is, in my opinion, not unreasonable. And really what I look at is where has the stock been in the past. So we can see here in the last year, it's been around 280 previously. And then even kind of just beyond that, you can see back a year and a couple of months ago, so in October 9th-ish it looks like, the stock hit $300. So for me, it's not unreasonable for kind of the price to get up into this $280 to $300 mark. So then when I'm looking at it, right, I can look at the current price, which is $140.34. I can see that there's a potential upside there of 114%. So for me, I would be a buyer basically anywhere below 150, right? Because 150 doubled up would be 300, and that would be my 100% return. Again, this just depends what you are looking for and what you're happy with. And obviously, if the risk becomes lower, so if, let's say, if Apple dropped 25% or at a 25% upside, that, in my opinion, would have lower risk than Alibaba. So in that instance, I would probably be more willing to take the little bit of risk there for a 25% return instead of trying to hold out and hope that the stock goes down 50% so I can get 100% return. So hopefully that kind of makes sense. You need to kind of consider those factors and then take them into consideration when you're buying and what your kind of price target is for any certain stock. So step 3, determine where you want to take profit and where you would cut your losses. So we kind of already discussed, obviously, take profit. So I would be looking at 100% return, which would be the $300 mark for take profit. For stop loss and take profit, I kind of, I normally do kind of like a trailing. So if I see if the stock hits 300 and I still see a lot of potential for it to run up, then obviously I'll let it run a little bit more. But that just gives you at least a general idea of where you would want to get out of the position, which is a good thing to have before you even start a position. But what's more important is your stop loss. So your stop loss, you want to look at, right, how much are you basically willing to lose on this position? So in my opinion, basically looking at Alibaba and looking at it kind of over the long term, you can see back in 2017, it was at $100. So this was a while ago, and it looks like it has at least some support or resistance there. So what I would be looking at is, right, if the stock drops below, and 2017, the reason I kind of choose that is, right, 2018, we had all that China, basically the trade war with China. So the stock pulled back, and even then it pulled back to 132. I don't see what's going on now any real different than this timeline. So if we see the stock pull back below kind of what we saw even before that and during that time period, then I would start to basically get a little bit worried. So that's kind of where I personally am coming up with that number. But obviously when you look at any stock, you kind of want to figure, you can look at technicals, look at news, look at the kind of the previous chart and see where you are comfortable and where you think the stock, right, if it goes down to $100 and basically breaks that $100 mark, I think there's basically a lot further that it can fall. So I'm comfortable, right, losing that kind of, what, 25%, 25 to 50% on my money if I invest at 150 and then basically the stock drops down to 100 or slightly below. So that's personally where I'm comfortable. Again, you have to evaluate the stock, look at kind of where you see some support and resistance, and kind of take into consideration also other factors, right? There could be new news that comes out on Alibaba that basically is very negative, which we've seen in the last week with some of the revenue numbers that have came out, and that's kind of why the stock has dropped recently. But in my opinion, I still see China growing a lot, and I don't really consider that as a major risk to the company. So really that's what you need to determine, and you really need to determine your take profit and your stop loss before you even put the position on. Step 4 is to actually start your position and start dollar cost averaging into your position. So what I have here are 3 scenarios for our example of Alibaba. So again, the total position size was $12,000 is what we're targeting, and we have a mild, aggressive, and a conservative position. So mild here, what we're doing is we're basically just split the investment of $12,000 across 5 positions. And these 5 positions could be, if you want to be, again, mild but kind of aggressive on how you establish the position, you could do once every day for a week, or you could do once a week for 5 weeks. It's kind of up to your preference there. But basically what you're going to see is, right, you're going to build out 5 different positions in Alibaba. And what I've done here is broken out the approximate price, just a guess of what price maybe you might be at for each of those 5 positions. And then what that comes out with is basically what your dollar cost average would be on the entire position. So, right, you see this first position we put on at 140, then we put another position on at 150, 130, 120, and then finally $100. So basically this would be an example where Alibaba is at 140, it goes up to 150, and then basically drops and continues dropping down to 100. So you can see, right, it's better than building out your one position, building out your entire position at one time, because your cost basis then would be at 140, where right now with this kind of scenario you'd be at 125 for this mild example. So for aggressive, what we've done is basically build out the position really quickly. So we want to build it out and we want to start a position. This would be ideal if you think the stock is basically at a bottom and you think it's going to start going up really quick and you don't want to miss out, basically. So we have a $5,000 position put on in position 1, and then $1,800 for these next 4 positions. And again, that comes out to still our $12,000 total position size that we're targeting. But here again, we have the same scenario happening price wise, and your cost basis is now 128. So it's $3 higher than your kind of middle, where you just build it out equally over time. So that's again a little more aggressive. We built out our largest position to start, and that was at 140. So we were still able to get a lower cost basis than what we had originally. And then finally, we have our conservative example. So this one, because we're in these numbers, we have it dropping, we have Alibaba stock going down over time. This is going to be your best example, because we're basically doing the reverse of the aggressive. So this, you're building out a position very slowly. So you put 1,000 in your first position, 1,000 in your second, 2,000 in your third, 3,000 in your fourth, and then 5,000 basically finish off your position with your 5th position. So this is ideal, right, where you think the stock could keep going down. So if you think the stock is going to keep dropping, right, this would be your ideal situation, because you're at a 114 cost basis. So again, your original position was put on at 140, and now you're down to 114. So we can obviously manipulate some of these numbers to make different ones, different styles look better. So if we just change these numbers, let's say to 185, and then let's just say that we went up to 200 here, and then again 185 and 200, and then 185 and 200. So at this point I probably wouldn't be investing, I wouldn't be adding more to my position, but you can see how everything kind of changes, right? So your mild is still middle of the road, you're at a 156 cost basis, right? So you added just a little bit over time, $2,500 about over time across all these prices in here, and you came out to 156 for your cost basis. When you're aggressive, right, you put in a lot up front and then put in about 1,800 the rest of these prices. So you were putting in basically less at these higher prices, and you're at 152. So a little bit better than the mild condition. And then conservative, right, you're going to be in your worst possible situation, because here you contributed a very small amount to start, and then you kind of ramped up your positions, and sadly, right, the stock went up as you ramped up your positions. So, which is a good thing and a bad thing, right? Because your position is only getting better, or you're basically only making money, but you're built out your largest portion of the position at your highest price. So your cost basis is going to be significantly higher. So here you're seeing it's almost $20 higher than these other two positions. So that's kind of a rundown on dollar cost averaging, as well as how you would want to build out a position in this situation. And finally, let's just jump into the last step, and that is to hold. So right from there on out, you're just holding your position, you're letting everything kind of work itself out. You have your price target in mind of $300 for this example, and basically you're just waiting to see how things play out, right? Sometimes you're going to lose and you're going to have to cut your losses, other times you're going to win. So I hope you guys enjoyed this video. I hope you took a lot away from this video. I think there was a lot of good information in this, and I hope you enjoyed it. If you did, leave a comment down below. Make sure you drop a like down below. And if you want to see more videos like this, make sure you subscribe. Otherwise, I hope you have a wonderful rest of your day.